All right, so we're recording. I'm going to share the screen. Thank you guys for your time. This is Forensic Forex with Deontay, and we're going to be talking about last night's Asian session model. So this is going to be episode 37, I believe, if I'm correct. Episode 37 to the Asian session library. And last night on Tuesday, the 20th, February 2024, we were able to see a successful Asian session model. Let's walk through it together. So it's a very simple idea. I don't ever try to overanalyze what I'm doing here. The whole point of this model, in its very generic way of telling it, is that the market is going into consolidation. It is breaking one side of that consolidation, most likely, and then running to the other side. So, for example, we can see the market is clearly range bound. It's not making significant higher highs or significant lower lows. It is pretty much range bound. So at this point of time, 12 p.m. to 8 p.m., that's the New York lunch, also known as the dead zone. That's what I like to call it. And a few of my other fellow traders like to call it the dead zone. I don't trade here because we're most likely going to run into a phase of consolidation. Now, how do I know that? Well, just looking at it, if we were to highlight 12 p.m. to 8 p.m. with a session indicator, we can see most likely than not, you can see there's consolidation. There's going to be consolidation between 12 to 8 p.m. The market at times will be very trendy, but odds are it's going to consolidate. We could just see it here, right? If we just go through a couple of days throughout the week, Tuesday, the market's consolidating. Monday, the 12th, it's consolidating in the afternoon, right around 12 p.m. Right here. Friday, the afternoon, look how market is consolidating. Likewise here, Thursday, right? So you're going to slowly start to get the picture. It doesn't take far. We don't have to go that far to see that within that time period, you're most likely in a phase of accumulation. And that's Monday. And look at that Friday, so on and so forth. So we know we should not be trading that as a day trader. We just want to completely avoid it. 15-minute swing high, what is that? That's buy side liquidity. 15-minute swing lows, we have multiple ones here. One, two, here, second one, and third one here. So you have three sell side liquidity pools here and just one. All markets start in consolidation, which is very crucial. I like when the market goes into consolidation. The reason why is because that's when I know the market has gotten quiet, also known as what Larry Williams would quote it as a small range. A lot of people are uninterested with what's going on with price, or they're stuck in a paradigm. Psychologically, it is really painful, mentally painful to trade in a environment like this at times, unless you're a really good scalper, right? But we're talking about the average trader. This is difficult to trade in because when the market looks to go up, for some reason it looks to go back down. So it feels like the market's against you. You start buying, the market sells off on you. And then you jump out of your buy, you go into a sell. And then it turns around again. And you're like, wait, I thought it was selling. Now it's buying. And now you start to get stuck in this paradigm. And all this way, a lot of people are losing money because they're just chasing price. There's no guidelines or restrictions or responsibility being taken by them as the trader, not understanding that you can't just trade at any point of time of day or using it by breaking a swing high or a swing low. So we're looking for a false break. In order for us to find a good trade, something tragic has to happen in the market. And that tragedy that is constantly happening in the market is orders getting stopped out. Simple. And that's where the hands flip. That's when all of the water comes rushing through. That's when everything starts to shake and crumble. And that's where the opportunity is shown. But nobody sees it in that opportunity, right? They see that opportunity as breakout. Most times, some traders are right, but I prefer to be opposite to what most traders are going to do. Counterparty. If everybody thinks they're going to go long, I'm going to go short instead. This model is not based on higher time frame premise. It's a very short term idea. Vice versa. If I see this, most traders are going to probably see that instead. But I see this. I prefer that instead of the continuation. And that's one pattern I see often with the Asian session. Now, there might be other patterns as well, right? A continuation pattern, of course. I like to see that reversal pattern often, and that's what it is. So price comes up, breaks that 15-minute swing high. At this point, I am telling myself I want to be a seller because right here is where all the hands start to flip. That's where all the buy stop orders are triggered. In that moment of triggering the commercial speculators, right? And my ideology and my belief system and how the market works and who's the highest entity in the market and controlling price action and how it's delivered to us on the screen. I believe it's the commercial speculators, also known as the market makers. The commercial speculators at this point has caused everybody to chase price long, but this is their moment to go short and they can seize that opportunity here because anybody that was going short here, they have a stop loss order, a buy stop order to prevent buying into their order. That's why it's called a buy stop. I know it sounds funny when I say buy stop. Some people are not familiar. Oh, it's called a buy stop. Yes, because you're stopping the buys. You don't want the market to eat into your sell opportunity. So it's a buy stop or a stop loss, aka stop loss. And we call that buy side liquidity. And we want to see retail traders chase this and go long and continue to buy into that. But we want to be opposite to their hands. We want to actually sell it to them because we know in the next couple hours it may decrease in value. And if it means decreasing in value since we're trading UJ, that would mean the base currency, dollar, would be getting weak while Japanese yen is gaining strength. If we ever see UJ drop, that's what that means. Vice versa, if we ever see UJ rally, that means the base currency, dollar, is gaining strength and the quoted currency is weakening. That's when we see UJ going up. So that's what that means as well. The fact that we're also above the Asian Open here, very crucial because the opening of a session is fair value. It's the opening bid. We're in a premium, it's expensive, right? We're in a premium and it just broke 15-minute swing high buy stops, buy side liquidity. We're looking for an entry technique. We're not looking for any fair value gap. We're looking for something very specific and very niche. We're looking for a fair value gap that runs through a swing low. And that swing low does not start, or its price point is not on the starting of the fair value gap and the ending of the fair value gap. And we'll talk about that when we get there. We got the fair value gap. Look at that swing low. Swing low formation. One, two, three. There's a higher low on the left and a higher low on the right. So that makes that swing low. It's a candle that on the left, the low is higher, and on the right, the low is higher. It only takes 3 bars. Since we're on the 1 minute, it only takes 3 minutes for a swing formation to form. So it's a fractal idea. Price can trade up into this, and that's where we're looking for the short opportunity, right into this fair value gap. So as price returns right to that discounted side, the bottom side where it ends, that's where we're looking to go long. We're going for a 15 pip stop loss and TP. So 1-to-1 scenario, risking $1 to gain $1. Very minimal odds here. And we can see how the entry point that we're taking, this is where the entry is, fair value gap plus swing low, because that's what it is. It's two things together. It's not just a fair value gap by itself. It's a fair value gap that runs through a swing low. It's speed, right? That's what we would also call this and define this. This is speed running in one direction and leaving an inefficiency here. You want to see price tap right back into that, and that's where we would want to go short. Let's play it forward. And we got 15 pips there and a little more than that. But in the process, you can see this consolidation that we got off of the 15-minute time frame right here. We utilize that to find a setup to go short to take out the liquidity pools on that consolidation. So it ran the consolidation high, purging, buy stops up here, and then traveling back down and taking out sell stops below lows. The market is always doing that. And while doing it, it's also creating a new swing, right? Or a new leg. And there's a range within that. And above that range and below that range, it also created new liquidity pools. So while it's destroying, right, and liquidating liquidity pools, it's also creating liquidity pools simultaneously. It's doing the same thing. It's creating and destroying. It's a constant flow of the market. It's always going to create liquidity. There's no doubt in mind that that does happen. And it's always going to be destroying liquidity. We see it all the time. People getting stopped out. Now, there's something that we know called algorithmic levels. So our 0 levels, our 20 levels, 50 levels, and 80 levels. It's something that ICT taught in a lot of his free tutorials on YouTube. And these levels tend to be the most sensitive or will give general respect or precedence to price. So let's take a look at some of these levels. So last night I said 150 is a very pivotal moment for, let's go my object tree. Here we go. For UJ 150. So you're gonna put on all these levels. Here, here, here. That was the second short. You can see that's the smash day candle there. That idea I was telling you guys about. There we go. So I went short there. That was my first entry. And I didn't go in with a second entry last night because I've already risked a lot on that one trade. Right? I didn't want to go in and risk any more. So I was able to get that successful 15 pips from that entry. And the entry was higher too. So it's a no-brainer. You want to sell higher. You don't want to sell lower. And notice the entry too, it's above Asian Open. So I'm definitely taking a objective stance on where I'm selling. I'm not selling at random points. It's a very cohesive, you know, list of processes. I have to sell in a premium. I prefer to do that because it's more ideal for me as the seller. Vice versa. If I was buying, I would buy below the Asian session open after taking out sell side. So looking at these levels, right? So we were in 150, right? So we'll do the 20. So 20, 50, 80. And the same thing will repeat on and on and on. And you can see, just looking at it, if you were to draw this all the way out, move this a lot faster. You can see, look at how price respects 150.80 right there. 150.80 tags it right there, sells off really fast. Look at how price then gets to the next level, the 50 level. Just want to drag it across without moving it, but this will do. Look at how price respects that level. Let's zoom into where it respects it too. So price trades off of that 150.80 level, comes down, hits the 150.50 level, runs back up, runs through it, and right for the highest point where there's no little to no drawdown after it. This trade had little to no drawdown. Right at 150.50, hits it. Boom. Sells off. Right at that level. Very meticulous. And it's really fascinating to see this too. It's very fascinating. We go to the next level. Next level is 150.20. See how that responded. So instead, it looks like we ran right through it, right? Just speed right through it. Also creating a break of a swing low. You can see how there's another PD area right here. But we can see this one sits between Asian Open. It's on the premium side and a discount side. I don't really like to see this, but most times when I have a scenario like this, and it's the first scenario that forms, I rather see more of that fair value gap in a premium than a discount. You can see how this fair value gap is more on the discounted side. I don't like that. So we have episodes where we talked about scenarios like that as well, which is why I tell people you got to watch the episodes because this comes in different ways at times. It's all similar. It's just like cousins, it's all relatives. 150. So this was the major one here. Look right there. Boom, 150 on the pip. That's crazy, man. Look at that. Look at that high. Look at the H up here. H. Look when I hover my cruiser there. 150. Boom, hits it. Sells off from it immediately. Insane. Insane. And then you can see how if you were to draw this all the way out, you can see how prices reacting to that next level. 149, 980. Trades down again. Runs back into what? 149, 950. Runs down again. Trades back up. It's running into 149, 920, and then so on and so forth. Very algorithmic, very meticulous in how it's doing it. And it's all happening and targeting sell side after taking out the buy side liquidity. So that's the whole stance of it. So step one, right? If we have to go over this thing all over again, step one, we have to mark off the buy side and sell side liquidity that forms inside this time period here. We find all the unbroken 15-minute swing highs and unbroken 15-minute swing lows. Or we're taking the highest high or lowest low we have in the session via 15-minute time frame. Take those liquidity pools, draw them all the way to 12 a.m. Look to see which side is broken first. We don't want to jump into this market or into the session just chasing price. Just because we see up candles going up on whatever time frame we're looking at doesn't mean we must panic and jump into FOMO. We've already structured the liquidity pools. We're being very objective. Nobody can't tell you that the model is not objective because it's very objective in the levels. It's not that I'm drawing a random supply and demand zone anywhere on this chart. It's not like I'm doing that. I'm not. I'm taking very specific price points, the actual highest high of the swing point or the lowest low of that swing point, and we're looking to see price rate it, purge, and revert. This is a reversal. You call it a reversal phase. You call it a turtle soup. You call it a false break. All the fancy terms you want to use. Tomato, tomato, same thing. It's a very simple idea. You can trade Asian session. I show it all the time. I'm not guaranteeing that the model is 100% accurate every single day, right? So I live in New York, and the Asian sessions that I have available throughout the week is going to be an Asian session Monday night, Tuesday night, Wednesday night, and Thursday night. Friday night, there's no Asian session. And I don't take the Sunday Asian session at all. I don't trade Sundays. I don't trade Sundays at all. I avoid Sunday at all costs. Do not trade Sunday. Besides that, you can see how the model is very simple. You can write this down on the back of a business card. That's how simple this is. You met a stranger in the street and they ask you, "Hey, if you had to give me a model, quick, short, and simple, keep it to the point. Don't waste my time. How do you make money? How do you make profitability in the market? Tell me what's your bread and butter model." It should be able to fit on the back of a business card. That's how simple the model needs to be. Of course, it's more complex than written down because you have other subtle nuances and the way it might come to you, depending on, let's say, you optimize it. Maybe you only want to take this trade mainly on Tuesdays and Wednesdays for some reason, or Thursdays only. Or maybe you only want to take it on a specific day that you have the most available time. Maybe that's Monday, maybe that's Tuesday, whatever day of the week it is. But in general, the model needs to be that simple that you can teach a child, that any stranger on the road that ran into you and asked you for advice on how to trade and what your model would be, it better be able to fit on the back of a business card. That's how simple it needs to be. You can teach your kids this, if fellas, I know most of the demographic is males. If you have sons or daughters and you want to slowly incorporate, trading into their life, not saying you have to force them into it, but it's something that you would like to see if they want to get involved in, if they take after it, you teach them this model. And I promise you, they can probably regurgitate it to you as they get some practice. The same way I'm showing it to you is the same way you can spread the message and spread it to other people as well. I think the New York session is the same idea. It's just a different dead zone that you're using. Instead of 12 p.m. to 8 p.m. for the New York lunch, like the Asian session, for the New York session model, the simplistic model is going to be from 5 a.m. to 7 a.m. That's a dead zone. And you use that for 7 to 10 a.m. I have a whole video explaining the New York model. Same thing for the London session model. It's the same idea, different kill zone, different dead zone. It's going to be midnight to 2 a.m. That's another dead zone. Use that dead zone liquidity pool to help you trade London 2 a.m. to 5 a.m. If you are not understanding anything that I'm saying, replay and watch this video again. So hopefully you found this insightful. This is episode 37.